Stoned Elf 2020. Please join me. And now I'd like to introduce Lou Pierro, our host. Hi, Lou.
Good morning, Beth. Good morning, everyone. We are very happy to have you here with us for the 25th Annual Elder Law Forum, our first virtual forum. Today is part 3 of our 3-part series. We've broken it down into 3 2-hour segments. And these segments and our forum this year is sponsored by 4 very, very generous sponsors. And we'd like to thank them right now. Quontic Bank, and you're going to hear from Frank Melia today, is one of our sponsors. Advisors Insurance Brokers, you're going to hear from Bob Vandy. NYSAR Trust Services, we had them on our first session on home care. And the Beacon Communities also was a presenter in session 1. The session 1 program, which aired on May 21st, was on housing challenges and home care challenges, and Lord knows we have plenty of those. We had phenomenal panels. I'm not going to go through them all right now. On session 2, May 29th, we had live interviews with 4 of our legislators, and we also had Greg Olson and Becky Preedy from the State Office for Aging and the Area Agencies on Aging, and they gave us a wonderful recap of where we are in the State Office for Aging in terms of innovation and programs. Our legislators gave us a deep dive into how they're coping with the COVID-19 pandemic, and Benita Zahn, our own local newscaster who's been with us before and is with us again. We're very happy that she was able to moderate that panel. Those sessions, if you didn't happen to catch them, are all available on our website. You can log on to pierrolaw.com and go to the resources page, and you can view sessions 1 and 2. The materials are also there from sessions 1 and 2. I highly recommend it. But today, we are excited to have expert panels 1 and 2 talking about senior finances. And we're going to dig right in to what it takes to plan and what it takes to manage a senior's finances. We as a firm dealing in elder law work with seniors and families, and we see the chaos that arises when a senior suddenly loses capacity, when they lose their ability to manage, and when they have expenses that they have maybe not prepared totally for, long-term care, home health care, other expenses. And our first speaker is Peter Gordon. Peter is president of New York Financial Organizers. He is a certified daily money manager. And if you've never heard of a daily money manager, you will today. And Peter manages finances, helps triage costs, medical bills, builds budgets. And Peter, if you want to join me on camera, I'm going to hand it over to you right now. Good morning. And let us know what a daily money manager does and how your job assists in the family's goal of making sure that the finances are in order and that everything is being handled properly. So take it away.
I'm happy to do that. Thank you, Lou, and welcome to everybody. So my name is Peter Gordon. I'm the president of New York Financial Organizers. And as Lou said, we're daily money managers. Now, what is a daily money manager, you might ask? Well, you probably know what a geriatric care manager is. And what we like to say is geriatric care managers do the pills and daily money managers do the bills. So what we do is deliver essential financial services to different categories of people. Certainly most of our clients are seniors or older adults. We also work with people with disabilities, busy professionals, and high net worth individuals. And some daily money managers also work with small businesses. About myself, so I've had an interesting career. It's actually my 3rd career. First was on Wall Street, mainly in the back office, trying to find my way around in the 80s. I eventually earned an MBA in finance and started working in marketing. And then I got the entrepreneurial bug, and I actually started a graphic design firm. About 12 years ago, my father became ill, and I chipped in and started managing his financial affairs. And this led me to managing my mom's financial affairs as well. And I became really interested in the world of senior services. So I decided to investigate it, became a certified senior advisor, and now I'm a certified daily money manager. I'm a member of the American Association of Daily Money Managers, as well as a past president of their New York chapter. And I'm also a co-leader of a wonderful group called the Orion Resource Group, where I'm a co-leader of the Manhattan chapter. The way we work with our clients is we're part of a trusted advisory team, and it changes from client to client. And you know, one of the things I love about what I do is that there's a great deal of diversity in the work we do. But pretty much our clients are, while the clients are the elderly, it's often coordinated by a family member. And then we work with elder law attorneys, financial advisors, home health care agencies, geriatric care managers, maybe doctors and nurses, a host of others. And sometimes, in addition, we're called on to act as a fiduciary, where we could be a power of attorney, maybe a trustee, or executor of a will. So I'd like to review the backbone of our process, and that is utilizing Quicken, where we download checking and credit card transactions. And we do this virtually. So we don't have to be with the client. It's done, you know, online in the cloud. And what's been wonderful about that is that over the last few months, we haven't had any disruptions in our business because of the virus. We've been able to work virtually, and going forward, we'll be instituting new changes with our clients to have them available to access Zoom and possibly send us documents as well. We're very concerned about security, and we use programs such as LastPass, Dropbox, password protected Excel files. I also have some clients use EverSafe, which is a program, a wonderful app you'll be hearing about in the next panel with Liz Lowy talking about it, that provides information about all the transactions clients have in their credit cards, checking accounts, as well as credit reports. So one of the things we also do is we prepare and review monthly income and expense reports and provide that to our clients. And in addition, we do financial snapshots. And I thought that a great way to illustrate all this would be to do a case study. So I have a wonderful client, Harriet, who is, she lives on Long Island. She's a 93-year-old retired teacher. She happens to have a long-term care policy. She owns a condo, and she's also in need of 24-hour health care, and she has an aide. Her big issue is that she's on a fixed income, and her long-term care benefit is being depleted. And it's going to run out in a few months from now. So she's also been running a deficit because of that. And here's a little excerpt of an income and expense report that we run. And you can see that her total income is about $3,400. Now that's before her long-term care reimbursement. And her monthly expenses are about $5,400, leading her to a deficit of $2,000 a month. And because we do this, and because we're able to have a monthly review of her income and expenses, we're able to come up with a plan to try to make up for this deficit. And one thing we also do for our clients is provide a financial snapshot of their assets and their liabilities, and then their net worth. So we get all this information online for the checking and savings accounts and the credit cards. We also work with our clients' statements directly, from their investment accounts. And then we do an approximation of the value of their home if they own one. So in this case, as you can see, the largest asset was the condo, and that's where we were going to as far as the solving this problem. So the solution involved the first step of the first step of the solution involved consulting with an elder care attorney. And we also coordinated with a mortgage broker, a mortgage banker, excuse me, much like Frank Melia, who'll be speaking later in this presentation. Now, unfortunately, the condo itself doesn't allow a reverse mortgage, but we were able to get, excuse me, it doesn't allow a reverse mortgage, which is a wonderful tool, but we were able to get a first mortgage. And after we closed on the mortgage, we put that the money into an account which was used by a trusted family member. And this enabled Harriet to be eligible for community Medicaid. In addition, we worked with an attorney so that the condo itself was in an irrevocable trust to further protect her legacy. We realized that because Harriet is depleting her long-term care, that we're going to need another solution to pay for her home health care aides. And we're in the process of applying for community Medicaid and also the CDPAP program, which is a consumer-directed personal assistance program. And this is all done in conjunction with the group of trusted advisors that I mentioned in the beginning. So in conclusion, it's obviously critical to plan ahead. You know, if you can, long-term care insurance is a wonderful vehicle, and that will be spoken about in this on this panel as well. And so that would involve years of planning ahead. But in addition to that, if once once our clients are starting to see some cognitive difficulties in paying their bills and having some memory issues, it's really important for them to reach out for help. And when they come to us, then we help them track their income and expenses. We help them monitor their assets and liabilities, and hopefully, provide the solutions they need to live the lives they want to live as they go on towards the end of their life. So I look forward to having any questions at the end of this 4 presentations, and I turn it back to you, Lou.
Well, Peter, stay with me for just a minute, because I was a caregiver for my mom who had Alzheimer's, and I remember what it was like when we really first realized she had dementia, walked into the house and started collecting papers and bills that were overdue and things that were just completely out of control. She had subscribed to about 20 magazines thinking she was going to win the Publishers Clearinghouse sweepstakes and was getting Popular Mechanics. My dad had passed away. You are really a resource for the caregivers in addition to the people. And just talk a little bit about the case. We share a case where you have remote children. You have kids all over the world, and you have mom in New York City in her apartment. How do you get involved, and how do you interface with the children?
Well, that's a great question. And what we do in that particular case where we share the client, we were originally brought in by the geriatric care manager. And what happened was there was a home health care aide who wrote a check to themselves and resulted in fraud. And it really quite literally freaked out the client, and she didn't know how to handle it. So we were brought in at that point. We do our best to contact the children. It doesn't always happen that way. In this case with our client, her son is wonderful and is very involved. And so he's in California, and we stay in touch with him by giving these reports. And the first step is to come in and really go through all the paperwork. It is usually a stack of bills and mail, and review that together. We're not there to take control. We're there to be a partner with our clients. And depending on their abilities, we work very closely with them. And then have regular conversations as the client's children might want, because unfortunately it's not always that way. And then there are times where we'll be working as power of attorney when there is no family. And the most important part for this is to have that team of trusted advisors that we can all communicate with. And from my experience, there is no one go-to profession. It might be the attorney, it might be the daily money manager, it might be the geriatric care manager. But from my experience, once we form that team and the communication is there, things go very well.
Thank you, Peter. Again, if anyone has questions for any of our panelists, you can post them. There is a chat box on the right side of your screen. You can type your question in, and we will have time for questions at the conclusion of the formal presentations. I want to bring up Ray Radigan next. Ray, if you could come on. And Ray Radigan is a senior vice president at TD Wealth. He's the head of the private trust department. He's responsible for managing trust activity across the company from Maine to Florida and overseas. He oversees trust advisors and financial planners who offer the full ranges of TD Wealth's planning. And today, Ray, welcome. Ray's going to share with us TD's financial planning model and how they work with seniors in managing wealth and managing their trusts. Ray.
Thanks, Lou. Good morning, everyone. And as Lou mentioned today, I'm head of not only our trust activity, but the planning activity at TD Wealth. TD Wealth is basically the private banking component of TD Bank. And we have a tool today that I'd like to show you. It's called TD Wealth Plan. And what we use TD Wealth Plan for is to help our clients with their retirement planning. We focus in on their retirement planning. And, you know, the general question is, hey, based on my current situation, do I have enough money to support myself, possibly my spouse, during my retirement years? And if the answer is yes, that's great news. And it gives them a sense of comfort or what have you. But if the answer is no, then the question is, okay, what can I do differently to help increase my probability of success, to make sure that at the end, I do in fact have enough money for my retirement? So what I want to do today is, excuse me a second, trying to advance the slides here. Okay, so what we do is we gather information, and in this particular plan, I'm going to show you a sample plan. And what we did is we had 4 different scenarios. The last scenario, or a couple of scenarios, involved basically it's a 62-year-old couple, if you will, and we basically assumed the husband would live to about 87 years old, the wife would live to 95, and then we also assumed in some of the scenarios what happens if they have to worry about long-term care expense. And you can see on that first line there, we assumed for this particular scenario that the annual expense for long-term care would be $120,000. Now, having said that, our footprint is from Maine to Florida. Obviously, nursing home expenses vary depending on where you're located. You can put any number in there. The planner who worked on this particular plan is in suburban Philadelphia, but used $120,000 as the annual expense, and also assumed that that would increase by 5% a year. And then the second line there shows the long-term care insurance with an annual premium of $67.50. Again, what we typically do is work with long-term care insurance providers and experts, and you will see that there will be a scenario dealing with long-term care insurance as well.
Ray, I just want to remind our listeners, they can download the slides. If you have a smaller screen and you can't read them on screen, you can download the slides right off of the toolbar. So sorry for the interruption.
That's okay. So this next page, there's other financial information there, but the important part is near the bottom there. We assumed that this couple would be spending $84,000 a year during their retirement years. By the way, I mean, you can put it in any number you want. It could be 74,000, 94,000. There are many variables here, and I'll get into that as we start getting into the plan itself. And this is just personal information about the client. It's a 62-year-old couple, if you will, husband and wife, 62 years old. They have 2 kids. And basically, the next slide shows their assets. They're pretty well to do. They have a net worth of about $3.3 million, of which $3 million of it is investable assets, and they have a home and a mortgage. And then the next slide basically is their current portfolio allocation. Now, what's interesting in this particular case is more than half of their assets is in cash. Now, the good news is that cash, it's relatively safe, right? That's the good news. The bad news is you could have pretty anemic returns. There it has a rate of return of 2.04%. I would argue long-term that might work. Short-term, that's going to be a stretch. And by the way, in this particular, what I'm showing you is about 11 pages. The plan that we have on this particular case is 85 pages. And there's a lot of disclosures. There's a lot of information about individual assets. Obviously, we don't have the time to get through that, okay? So what we did in this particular plan was very interesting, is we went through 4 different scenarios. The first scenario, we said, what if they leave their assets as is? And what if they also decide to start taking Social Security at age 62? Again, there's variables. Social Security 62, you can wait till full retirement age, you can wait till age 70, and depending on what you pick, the probability of success is going to change. So again, scenario number 1 is assets are as is, spending is what we said, $84,000 a year, and they're going to start taking out Social Security at age 62. You can see in that first scenario, probability of success is 69%. Rule of thumb, you want basically the confidence zone to be north of 75, maybe north of 80%, right? And we'll get into these individual scenarios in just a second. In the second scenario, what we did was we said, we changed 2 things. We said, we're going to change your asset allocation, all right? You have way too much cash. That's great for safety, but it's going to basically suffer when it comes to your rate of return. So what we decided to do is we assumed that they implemented an asset allocation of 50% stocks, 50% fixed income, and we made one other change. The one other change is we waited until their full retirement age before they started to receive Social Security. And lo and behold, now we boosted basically the probabilities of success from 69% to 83%. And again, anything north of 75% is where you're going to start to feel relatively comfortable. The third scenario, what we did is we have this couple. We assumed the last surviving couple, in this case it would be the wife, would end up in a nursing home for the last 3 years of her life. All right, and that's the only future factor we played into that scenario. And you can see now the probability of success went from 83% down to 55%. And I'm like, okay, so how can we change this? In the last scenario, all we did is we kept the fact pattern the same in the third scenario. Basically, the wife goes into a nursing home the last 3 years of life. The only difference is now this couple basically buys long-term care insurance. And again, we plugged in that number. And typically, we'll work with a long-term care expert to figure out what's the right coverage, what's the right annual premium, et cetera. But the point is, when we plugged in this information, now the chance of success went from 55% to 77%. And just to look at this more closely, when you look at the first scenario, what we do is, again, the punchline is there's a 69% chance of success. And the squiggly lines you see in that graph is part of what we call our Monte Carlo trials. What we do is a Monte Carlo simulation. We run 1,000 different scenarios. It's like this person lived their life 1,000 times over. And there's best case scenarios, there's worst case scenarios. And based on that Monte Carlo analysis, it's determined that there's a 69% chance of success. The green line in this graph is basically the average rate of return for those assets. Again, the scenario is the asset allocation is untouched. It's a lot of cash, 36% equities, and Social Security was start to be taken out at 62 years old. And you can see on the bottom, the side is there's some other printing on the slide, but at the very bottom there, you'll see trial number. It'll say 750. A little hard to see, but that's the 25th percentile. If you go all the way to the right, you'll see at some point you're going to run out of money. So the point is, there's scenarios where, worst case scenario, you might run out of money with this plan in place, which gets us to the next plan. The next plan, again, we adjusted the asset allocation. and we significantly, we waited till full retirement age before they started to receive their Social Security, and now we bumped up probability to 83% chance of success. And again, you can see on that chart below, it's only the worst case scenario do you run out of money. So your level of confidence is pretty good, right? The third scenario is the same as the second scenario. The only difference is wife enters into a nursing home the last fully 3 years of her life, no long-term care health insurance. And you can see now we're down to a 55% chance of success. That's not very good at all, obviously. So one last scenario is we basically have the same as scenario 3, but what they have done now is purchase long-term care insurance. And now we bump that up from basically 55% to 77%. So this is a great tool. It's a great visual. And what it does is it gives the client, it gives them a visual as to, okay, what are my chances? It's a dynamic tool. You can change the scenarios. You can change the factors. Again, whether it's Social Security, again, whether it's spending money, again, whether it's their longevity. In this case, we had husband living to 87, the wife living to 95. You can change that as well. And it's a great dynamic tool. And the last point I'll make is what's great about this particular tool in this particular case, the couple was 62 years old, so they had time to plan. And this showed the potential consequences if they made certain changes. So Lou, I'll turn it back over to you.
Thank you, Ray. Ray, in your experience, how many people have actually done a full financial plan? What percentage?
Percentage-wise, I'd say it's low. I'd say it's something no more than 25%. I think, quite frankly, in this pandemic crisis that we're going through right now, people have the time to think about things like this, and we have been doing a lot of these plans remotely. You know, I think the number over time will change, but it's not nearly as high as it should be.
It's a great tool. I mean, it's very impressive, and using the Monte Carlo, giving the simulations, giving the ability to be predictive and to chart your course forward seems to have great advantages for clients.
It does. And just to be fair, TD Wealth is not the only financial institution that has this tool. This is basically built by MoneyGuide Pro. Very common tool, but it's very commonly used, especially helping clients get through their retirement years.
Excellent. Thank you, Ray.
Okay, Lou.
So we've talked about managing finances and creating budgets and managing budgets when people are in a position where they have basically charted their course and now they have to manage it and navigate it. And with Ray's presentation, we're talking about the planning aspects. How do you plan in advance? How do you simulate what the results are going to be? And how do you chart that course as the navigator with all of your charts and tools? Next is how do you ensure the risks that are inherent in that plan? And as Ray said, when the time comes to talk about insurance, you want to find a long-term care expert. And I can think of none better than our next speaker. Bob Vandy is the president of New York Long-Term Care Brokers, which is now Advisors Insurance Brokers. And AIB is a national fixed insurance brokerage general agency. Bob, that's a mouthful. You can explain that. But they service insurance agents and financial advisors across the country, satisfying their insurance needs, both life and long-term care. Bob is a close friend and a longtime partner in the show Life Happens Radio on every Saturday morning. I give you the velvet voice of Bob Vandy.
Oh boy, the velvet voice. What an introduction. Lou, thank you. And thank you also. It's great to be part of the 25th annual Elder Law Forum. I can't believe it's been 25 years. It's been a couple of years since I've been able to join as a presenter, so I appreciate the opportunity. And I applaud you and Aaron and Peter and the whole team at Pierro, Connor, and Strauss and the job that Beth has done in coordinating this. It would have been very easy, I think, to scrap the session this year, and I applaud you for not doing that, for leveraging technology and giving all of us the opportunity to kind of get the word out there in terms of what's going on and how can consumers, how can clients best plan financially and otherwise, for the impact of long-term care. Peter did a great job, as did Ray, and I hope to dovetail on that, and I'm looking forward to Frank's presentation as well. Certainly the financing is a big part of long-term care planning as a whole, as we all know. And my role here in this session is really to take a look, as Lou alluded to, the insurance-based financing capability that we've got with the overall plan. And I think a good place to start is really to couch it with why private financing is so important. And I think Ray did a great job of showing from a 20,000-foot view level, when you're doing an overall or holistic financial plan for someone, one thing that is important to note that has changed with long-term care insurance in a generic sense is there was a time not long ago where we felt like long-term care insurance had to be the end-all be-all, where whatever you purchased would be enough to satisfy the whole financing need for long-term care planning. That has gone by the wayside, admittedly. It's frankly unaffordable for most people to only use private long-term care insurance as the sole funding mechanism. And when you look at some of the numbers that Ray used, the $120,000 a year, you can see it's actually higher than that. As Lou and the team know, here in the Albany area, it's even higher than that for a facility stay for long-term care. The good news in that is that 80 to 85% of the long-term care that's given is still given outside of a facility. So when we consider that, the attendant cost to a majority of the care that we receive doesn't necessarily have to be the $120,000 or even higher that we might encounter in a facility. Although if we're planning for whatever the catastrophic cost might be, it's completely appropriate to do that. Clearly, the other thing that we found, and Greg Olson and some of the other presenters last week and so forth alluded to the fact that we have issues on both the private and the public financing side of long-term care. So to me, having components of both the public and private financing mechanisms is going to be vital as we go forward. So what we're going to do here in the time that I have remaining is really talk about the options that we have available, and they fall essentially into two buckets. The first is the traditional or standalone long-term care insurance that we've known for quite some time now. And that really comes in two flavors: traditional standalone long-term care insurance, and then also something that falls under what we call the New York State Partnership. I'm going to talk in a moment about the status of New York State partnership policies. More recently, we've seen what we commonly refer to as hybrid or combination policies, which in New York State combine life insurance policies as a base with a long-term care rider. And they come in a couple of different forms as well. One is something that we refer to as linked benefit, which we don't really have time to get into the technicalities of it, nor do you want me to. But a linked benefit policy is often funded with a single lump sum that a client might asset reallocate from one bucket of money over into an insurance pool, and a long-term care benefit is provided in that structure. Or we've also had more recently life insurance policies that offer a special, what they refer to as living benefit or acceleration benefit, where you can accelerate the death benefit in the life insurance to pay for long-term care, or as we sometimes refer to it, chronic illness. And there is a subtle difference between those two. So as we move forward, we're going to take a look at traditional long-term care now, and I want to talk about the status because some things have changed. Some of these are going to be familiar to some of you, or if not all of you. The first is we do have fewer carriers in the market. We really have two meaningful long-term carriers, at least in the brokerage space here in New York. There are a couple of what we call career carriers that are added in there as well. We used to have 10 or 12, but now we're down to a couple, but they are good, solid carriers that we have now on the traditional long-term care side. Underwriting has tightened a little bit. One of the things that has taken place in the last 10 or 15 or 20 years in particular is the industry has learned. It's learned about pricing and some of the mistakes, frankly, that they made. They've learned about underwriting and things that they need to take into consideration there. One of the changes that has been made is we used to have what was called unisex pricing, which meant that men and women of the same age and underwriting class paid the same premium. Now it's on a sex distinct basis. So women actually pay a higher rate than men, everything else being equal in that same age and rate class. So that's been a change that we've seen. Many of you, probably all of you, have heard about the premium volatility with long-term care insurance. Without getting too in depth, I don't think that serves us today, but I would tell you there were two main factors that have led to that: interest rates and claims experience. With the ongoing, prolonged, significant decrease in interest rates, that's had a tremendous impact. on life insurance, long-term care insurance pricing, as well as the reserving that takes place to make sure the carriers have money to pay claims. The good news here, by the way, and with regard to claims, by the way, the big impact there has been with regard to many more people keeping their policies than we thought. Excuse me. Partnership, unfortunately, we've seen has gone a little bit by the wayside. Unfortunately, we have very few carriers, pardon me, we have very few carriers that are participating in the partnership right now. I'm going to talk a little bit more about that in a couple of minutes. The last thing I did want to mention is there is a difference too between reimbursement and indemnity in terms of how claims are paid. Reimbursement, as the name indicates, essentially says that if I have a policy, I get reimbursed for the cost of my care up to whatever my benefit is in the policy. Indemnity basically pays a benefit and I can use that money for whatever I want. So it provides a little bit more flexibility. Although with reimbursement, I do have the ability to assign benefits to a claim provider or a care provider rather. So there is flexibility with both, but indemnity or cash indemnity without question provides a greater degree of flexibility from a claim standpoint. I want to take a minute and just give a couple of quick examples. One of the misnomers that I think is out there, I do get this, our role, as Lou alluded to, is we're a distributor. We work with insurance agents and financial advisors as that subject matter expert with regard to, among other things, long-term care planning and specifically the role that life and long-term care insurance can play in that overall planning. And one of the observations I've made is that there seems to be a misconception out there that long-term care insurance is the most expensive option. What I want to do here very briefly, and I'm going to move quickly, I admit, because we have limited time, is I wanted to just give a quick example where we keep about as equal as we can a benefit assumption and show what the various premiums for the various options would be. So what I've done here is I've taken a 55-year-old male, and I want to give you just a brief view of what that might look like for the various options from a premium standpoint. So in this instance, I've just created a $300,000 long-term care, what I'm going to call a benefit pool, and that would be payable at $6,000 a month. You can see for that 55-year-old male, you can do that for about $211 a month. Comparing that with our other two options, and I should add here, by the way, I did add this slide. I think it's important that we point out that that $211 that you see here in the premium, as you can see in the orange box, that premium includes a rider called return of premium. One of the concerns that people have sometimes is, gee, what if I buy this long-term care insurance and I never use it? Well, it's like, generally speaking, auto insurance or homeowners insurance or liability insurance in that you generally don't get anything back. But one of the important points I wanted to make this morning was that you can add a rider that will return premiums less any claims paid at your death if you never use it for long-term care. That's an often misunderstood and frankly unknown benefit that a lot of people don't think about. So it's important to keep that in mind. I mentioned linked benefit. As I think I also mentioned, it's typically funded with a single premium. You do have the ability to spread out those premium payments, but just for purposes of example here this morning, a linked benefit policy combines a life insurance death benefit and a long-term care benefit. And in this example, that same 55-year-old male could take a lump sum of $66,622, put it into a linked benefit policy that would provide a $100,000 death benefit, as well as that same $300,000 benefit pool that we're comparing, again, payable up to that $6,000 per month. Same 55-year-old, same standard health class in this instance. At death, the enhancement, if you will, I'll put that in air quotes, is that I would get, or my estate would get, the $100,000 death benefit back to the extent I had not taken long-term care benefits. So those products have been very attractive. The third option that we talked about was a life insurance policy with an acceleration, or what we call living benefit rider. In this instance, that same $300,000 benefit pool we'd like to create in the form of an acceleratable death benefit. I could buy one of those as a 55-year-old male. My premium for that is $406. Now you might look at that and you'll say, well, gee, that's a lot higher than the $211 for the long-term care insurance standalone with the refund or return of premium option. The difference here, of course, is that at my death, I'm not just going to get my aggregated premiums back into my estate. I'm going to get a $300,000 death benefit, and that can help with some additional planning I may be doing. So in that hybrid or combo situation, these policies have gotten very, very popular.
Bob, we have about 1 minute.
Thanks. I'll go quickly, Lou. Here's just a quick snapshot, by the way, of what I just showed you. Again, the slides are available for you. It's the one important point that I'll make, as you can see in the yellow box, is none of these options include inflation. I will tell you that in practice, inflation is often included in traditional long-term care. I find that's not often the case with the other two options that we read and hear about. So wrapping up, what I would say is that these are really the things that consumers want to keep in mind in terms of determining what might be their best option. Where am I going to get the best benefit per premium dollar? And generally that's going to be traditional long-term care. What do I prefer, reimbursement or indemnity benefits? You can see how they variously play out there. Do I want a premium guarantee? We still do not have that, although there's a lot more stability in the market today with traditional long-term care. But if that's a concern, I can get that with the other two options. Obviously, those other two options provide additional death benefits. And if I do want to coordinate my planning in a broader estate planning context, really that last option, the life with the acceleration rider, works very, very well with a trust planning situation. Lou and I have worked together on a number of those types of situations as well. Tax incentives, traditional long-term care still has the edge there. I did have some content here for COVID-19 as I wrap up. I'll just leave that up there and say that it's important to know that claims are payable under a COVID-19 situation. Too numerous to mention are the changes that have taken place from an underwriting standpoint, but good to know that there still is the ability to get the insurance even despite the current COVID-19 situation. So with that, Lou, thanks so much. I'll turn it back over to you.
Thanks, Bob. I wish we had more time to get into more depth, but again, I want to let all of our viewers know that our slides are available on our webpage, pierrolaw.com, and you can go to the resources tab and you get everyone's slides. So Bob's full deck is up there, as is Frank's. Bob, one of the things we talked about in our earlier session was the new Medicaid rule, which is imposing a 30-month look back for home care benefits. And there's a thought that perhaps ensuring that 30 months now may become a new standard. And there are companies, I think, working on policies with more limited benefits and a more reasonable premium, maybe fit that model.
Without question, Lou, as I alluded to earlier, the likelihood of most consumers being able to afford a policy that covers the catastrophic cost of care for an extended period of time, it's just not practical, unfortunately. We'd love for it to be that way, but it's just not practical. However, a more modest benefit that can pay in particular for some significant home care inside that 30-month look back period, I would tell you that 3 years is the most common benefit period that people are buying nowadays. So that dovetails quite nicely with those pending changes that we're seeing in New York under the community-based care.
Excellent. Thanks, Bob.
You bet. Thank you.
Remember, you can post questions to our site, the chat box over on the right. You can post your questions there. And I want to bring up our next speaker, and that is Frank Melia. Frank is a vice president at Quontic Bank. He's a certified mortgage planning specialist. He works closely with the Elder Law Trust and Estates Bar. He also works with financial advisors and realtors. He's become somewhat of a specialist in lending into trusts and interpreting trusts, which is, anyone out there who's an attorney knows, for most banks is a real challenge. And I want to give you, Frank, all the time we can, so take it away.
Thank you, Lou. I had a little bit of technical difficulties, so I just switched to a laptop, so I'm glad I made it on time. Good afternoon, everybody. I'll be the last speaker. I appreciate your time, and I know you've learned a lot so far from Peter, from Ray, and from Bob. What I'm going to cover this morning is the mortgage side of when we help our senior population age in place. The way we approach a family is usually through a team approach, like you've heard the other speakers mention this morning. So we'll usually get a call from an elder law attorney in the area, like Lou or Peter or Aaron, and we'll do what we call a financial assessment. For the geriatric care managers in attendance today, we understand that you do the physical assessment and look at how the family is aging in place safely. When I say financial assessment, I simply mean that we are going to look at how to provide equity or provide capital for the family to age in place safely. And many things that we look at is how the homes are, how the property is titled. What I mean by that is if the individual owns their property, real estate is usually most individuals' largest asset. So when we look at the mortgage side, we're going to look at how the property is owned and titled. So if someone owns a property individually or owns the property jointly with their spouse, there are different lending options that we can provide. If the property is owned in a life estate, there are certain options that we can also offer the family to provide liquidity. What we specialize in at our bank, and what I've worked with homeowners for the past 10 years, is also if the property is owned in a trust. Some families put their properties into a revocable trust, and some families may look to put their property into an irrevocable trust to protect their legacy and to protect that asset. So we do offer different options for those types of ownership, and we will get into a couple of specifics. Sorry, I went a little too far. One more. There we go. Home repairs. When we get a call or we're called in with the team approach with the other professionals that you've heard from this morning, we are usually asked to go over different types of, not requirements, but different things that the homeowner or the family member is looking to accomplish to keep their parents safe in the property or keep their spouse and themselves safe in the property. And the things that we come across the most is usually home repairs. Sometimes it pertains to a parent or a spouse that was in a rehabilitation center and is coming home, and they need to provide or keep the property in a safe manner so that person can age safely. So we get a lot of requests to look at the property, look at the equity in the property, and provide different options. We find families will look to maybe install ramps if a spouse or a family member is now wheelchair bound. We've had families that have had to adjust and help accommodate bathrooms and hallways, which is where a lot of our senior population has falls or find themselves in tough situations. We also, the top three, like I said, were home repairs, keeping the family safe, and home health care, obviously private pay care. If the family has spoken to an elder law attorney and they're on community-based Medicaid, or they're looking for or they have a long-term care policy that's paying for their care, sometimes there's a gap. Sometimes there's additional funds that are needed, and some families go private pay, where they work with the private home care agencies, and we'll look at different mortgage options and different options that can provide that liquidity and provide the capital, like I said, to keep the family safe in home and to make sure that everything is taken care of.
Bruce,
Sorry.
I think we need to get back to our current deck.
Yes, I will get us back there. 1 second, please.
There we go.
Okay, and I know we're having some technical difficulties, Frank. If you like, just say next slide, please, and I'll take you to the next slide.
Next slide. This is a typical scenario that we usually get. Previous slide.
That one?
This is a scenario a typical scenario that I come across often in the capital region of New York. We do service all counties in New York as well as nationwide, but I wanted to give an idea of a case study in the capital region. This particular person she was a widow, and her property was probably valued at about $250,000. And this particular scenario worked with a home equity conversion mortgage, which is the reverse mortgage program through the Federal Housing Authority. And I'm going to go a little bit into how the program works after the slide. But what we were able to do is secure, based on her age, a line of credit of $150,000. And the way the reverse mortgage works is, any existing liens on the property need to be satisfied and paid for at the closing. So she had an existing home equity line of credit, which she took out about 5 years earlier to do some home improvements for about $50,000. So what we're able to do and how the program works is we pay off the $50,000. So the only lien on the property is the line of credit, which is the reverse mortgage. And that gave this individual a $100,000 line of credit, which she can draw from when needed to pay for her long-term care costs. If they have a long-term care policy, it can pay for premiums. If they don't have long-term care insurance, it's used similar, where they can draw from it monthly. If the property is in an irrevocable trust or if it's in a revocable trust, we would release proceeds into the trust account, and then the trustees or the trustee of the trust would distribute those funds to either the healthcare provider, the home healthcare attendant, or any needs basically to keep that individual safe in their property. And we review the trust. We'll speak to the family members and let them know, usually the trust will dictate what can be done with the assets to keep the property safe, to keep the individual in the property, and for anything that individual would need to age safely in that property. When I talk about aging in place, we always go into different types of scenarios. There are a lot of families that we help locally. We're working with a family right now where her adult children are scattered all around the country, and we will coordinate with those family members, and we will help them. This woman particularly has dementia, and we do work closely with power of attorneys. So we'll work with the agents of the individual, and we also do work with guardians. We work through a lot of the guardianship courts throughout New York State. So we're very well versed in helping the individuals, helping the families understand what their options are when it comes to mortgages. I'll just finish up with that. In COVID-19, things have changed a little bit. If families do look to take mortgage financing while we're going through this COVID-19, there will be exterior appraisals. We don't have to go into people's homes. New York State has also allowed for e-notarization, which allows us to have a notary do a Zoom call or a GoToMeeting call or FaceTime to have certain documents notarized. We also are doing virtual closings, so we can help the families keep social distancing. And on an ending note, mortgage rates are at an all-time low. So if anyone does have any questions, we do offer 15-minute webinars, personalized webinars. And I'm here to help and service and answer any questions that anyone might have to keep their, family and the aging population safely in their property. Thank you for your time, everybody.
So Frank, the one question I get most often when I talk to people, and I just mentioned the term reverse mortgage, and they said, "Oh no, the bank's going to own my house." That's not true, is it?
I get that question too, yes. A lot of this started a little years ago. There were proprietary reverse mortgages that were around in the early 80s that did have different provisions. Once the Federal Housing Authority stepped in the Ronald Reagan administration and offered the program through the government entity, the provisions and the contract is pretty clear. The property stays in title as it is. So if an individual or jointly owned, it would stay that way. If it's in a life estate, we can offer that. It would stay in the life estate. It would stay in a revocable trust or an irrevocable trust. I always hear the government's going to take my home. My heirs get no money. That's not the case. They're going to get between 45 and 75% of the home equity, of the value of the property. And as you just pointed out, the most important thing is the property will stay in the family and it will go to their heirs. They only have to maintain their real estate taxes, and they always have to maintain their homeowners insurance. Those are the only two requirements.
So it's pretty clear that in order to do finances for seniors properly, you need a team approach. So I want to bring our whole team up, and we've gotten some excellent questions that I want to get us started with. So if everybody could click back on their microphones and their cameras, Beth is going to begin with a question for Peter. And this is a question that as attorneys we get as well. I think all of us probably get this question.
In fact, about 4 people have asked you, Peter, what is your fee schedule and how is it determined? Do you charge an hourly rate or are you on retainer?
So we charge an hourly rate, and we do that because every client is different. There's no way to tell how many transactions people are going to have, how many accounts they'll have. We find that the first month or two is going to be, between 5 and 15 hours, and then we settle into a system that we have in place, and we can determine what the monthly fee will be. And then we talk to the individuals about our monthly rate individually.
Excellent.
All right. We have one for Ray Radigan. How have the changes to the market affected the financial planning that is done with seniors?
It has. If you go back to the slides, there's a green line that shows average rate of return, and then there's a red line that shows bad timing. I would argue we're already going through bad timing. So it has impacted. What we've had to is clients who had a plan done a year ago, and they come back and they say, hey, stress test this, make sure this thing still works. So it clearly has an amazing impact on our plans that were done as recently as a year ago.
So Ray, the market seems to be running in an inverse course to the economy. Is this a bubble? What is TD saying about where we are in the valuations?
Who knows? Right now, temporarily, the market is thinking we're on our way out of this, and they're being a little bit optimistic. But we get a second wave of the pandemic, and then who knows what's going to happen? It's very uncertain times. There's no other way to put it.
Okay.
All right, Bob, can you name the carrier that writes LTC policies for people over 70, and roughly how much would that cost?
Well, I'll answer both of those. The raw reality right now, Beth, is that there are 2 main brokerage carriers writing policies now, Mutual of Omaha and Transamerica, and both of them are limiting the issuance of new policies to under age 70. That was one of the things that I was alluding to in my slides. I had to cut things a little bit short. So if you're over age 70 right now, unfortunately, the private long-term care insurance, traditional long-term care insurance, is not open. There also have been some significant pullbacks in the life insurance with the rider market as well over age 70. And that's largely due to the COVID-19 situation and the predominance of people being more adversely impacted by COVID-19 in that age demographic. I think it's important to point out too, Beth, that the average issue age for long-term care insurance right now is still hovering, as it has been for the last several years, at about age 57. I can't stress enough how important it is not to wait until you're over age 70. It's in a general sense the equivalent of waiting until there's smoke coming out of the kitchen window and then calling your State Farm agent and asking to get some homeowners insurance. They're going to want to know a lot more about why there's smoke coming out of the kitchen window. Maybe it's nothing, but it could be something. And that, unfortunately, there's more smoke when you're over age 70 in long-term care planning than below. As to the pricing, I don't want to be evasive, but it's almost impossible to answer because it's dependent on, certainly on the traditional long-term care side, how much benefit, how long I want that benefit to pay, how long I'm willing to wait and pay out of pocket before the policy kicks in. That's called an elimination period. And then whether I have any inflation. So the reality is it's all over the board. The example that I gave at $211 a month for the 55-year-old, you could probably double that for a 70-plus-year-old to get a policy of similar structure, if I had to guess.
One thing I will say, and I've been working with New York long-term care brokers since it was incepted, I think about 25 years ago, and now AIB, if I call their office and I say, I have a 61, a 62-year-old, here are their health conditions, here are the medications they take, within 24 hours, I have a set of quotes from a variety of companies. And the only way to truly know what that's going to be is to run the numbers. And AIB does a wonderful job producing that in real time and helping to satisfy the needs of the clients. Once you know what their goals are and you match the policy and the parameters of the policy, they can give you a very solid quote from that point forward.
All right, we have one more question, and there are more questions that we'll pose offline to our speakers today and post them. But Frank, what is the typical percentage of home equity available when using a traditional reverse mortgage?
It's an age-based program. So what I mean by that is the homeowners have to be age 62 or older to qualify for the reverse mortgage. And the older that individual is, they use the youngest age. So if it's a husband and wife, we always use the youngest age. And it's going to start for the younger age. The government assumes age 100. They don't use life expectancy. They just use age 100 for every applicant. So a 62-year-old would get a lot less, obviously, than someone over the age of 90. So to give a ballpark to the viewers, they're going to get anywhere between maybe 45 to 75%. So if you're in your 60s, you'll probably get 45 to 50% of the valuation of the property. That's how much the loan amount would be. Once the borrower hits age 90 and older, they would get 75%. So it's always going to fall somewhere between that 45% of the market value to a maximum of 75% of the market value.
Fantastic. I want to thank each and every one of our panelists for taking the time to prepare, to inform our audience, and to join us today. And I want to again thank our sponsors. And I want to thank each and every one of you for joining us and logging into the 25th Annual Elder Law Forum. At this point, we're going to take a 5-minute break to get yourself a cup of coffee, take care of the essentials. We'll be back in 5 minutes with a second panel, which you will not want to miss, dealing with elder